Hello, this is Michelle McVie at Life Benefits with how to pay back a policy loan for the beginner. The first thing to remember is that when you take a loan from the insurance company, it's an interest-only loan. Now, sometimes people ask me, do I have to pay the loan back all in 1 year? And the answer is no. You can have the principal out as long as you want. Once a year, at your policy anniversary date, the insurance company will send you a statement for any interest due on an outstanding loan. The insurance company will not send you a repayment schedule. But being a money manager, you'll want to create your own payment schedule so that you'll have increased funds to manage. Now let's look at the mechanics of how to make a loan repayment.
We're going to say that we took a loan in the amount of $10,000 and we put that into our money manager's account. And from there, we took a loan for our personal account, and then we used that money to go buy $10,000 of goods or services. Now it's time to look at making loan repayments. And so we're going to look at an example that we have used of what if you took a $1,000 loan, and what if on that $1,000 loan you paid $50 per month? Well, when we use those figures, people said, oh yeah, I could easily do that, $50 per thousand, and do that over 24 months. So then we said, well, let's look at with other amounts. So now we've done $10,000, and if we use the same formula, then that's going to be a $500 monthly payment for 24 months. And people have said to us, oh yeah, I can do that. So it's something simple, easy way to figure how much you could be paying yourself. Remember, the insurance company does not have a minimum amount. And so when we actually do the math on this, quite surprisingly, it comes out to about 18% interest. Now, if we first said we were going to charge ourselves 18% interest, that would have seemed rather high. But when we break it down to how much we're actually paying per month, that seemed more affordable. So just for illustration's sake, that's what we're going to use. We're going to use these $500 a month monthly payments, and we're going to take that money that's in our personal account, it's coming in from our income, and we're going to be paying it over to the money manager's account. And then from here, we can make the payment back to the insurance company. Now, you can do this in several different ways. First of all, let's go over here. When you move it from the personal account to the money manager's account, this can be done through a transfer. If you have it at the same bank, it's kind of nice. You can either set it up as an online transfer that's done manually once a month, or you can even set it up as an automatic transfer that happens. And then when the money gets here, well, then to get it back over to the insurance company, you're either going to write a check, or you are going to request an auto debit and fill out a form with the insurance company that they can authorizing them to debit your account once a month for that $500. Either way, it will end up back with the insurance company. If you don't like the idea of auto debit and you want to write a check, but you don't want to write a check each month, don't despair. You can allow several different months to accumulate here before you send it back over to the policy. Now, if you are going to not do this personal loan, but instead you're going to make a business loan of $10,000, now we have to look differently about the payment amount that we choose, because when we take a corporate loan, there are some tax advantages for taking a corporate loan. We get to write off some of that interest that we're charging ourselves. But if we're charging ourselves 18%, the IRS could get very interested in that and say that is way too much interest for you to be charging. So let's figure out this payment amount fairly. And so on $10,000, if we're charging ourselves 10% interest, we can probably justify that, and we're going to make those payments for 24 months, then that amount comes out to $461.45, and we could certainly round that for an even figure to $462 or even say $465, and of course then the last payment amount would be less. And we'll talk more about how to figure those calculations in another video. But for the sake of this video, let's just say we would go for this amount of $462. So, that $10,000 is out. It went and bought something to help us increase our productivity in business. And now that increased productivity is going to be coming back to us and our income in our business. And now we're going to have this $462 a month that we pay back to the money manager's account, right where that money originally came from. And now that money is going to accumulate here, and we can follow the process of paying back the insurance company just like we did with this $500, only now the amount is $462. In my next video, I'm going to talk a little bit more about another way to pay off the loan that doesn't involve the insurance company right away. Now that video is a little bit more advanced, so if you feel uncomfortable with it, please come back to this video, watch it again, and do these steps. And then if you later on, if you feel more comfortable and want to look at that video again, that's fine. But that's going to be a little bit more advanced.